Hello and welcome back to Dukascopy TV. We may be nearing the end of the trading week, but we've still got plenty more exclusive interviews for you. First up in the studio, I'm joined by Emmanuel Ferry of Banque PBS. Emmanuel, thank you very much for coming in.
Hello, Natalie.
Now, today we're going to be discussing asset allocation, and this is something that investors are constantly discussing the benefits of. However, there does remain two different types of asset allocation decisions. We've got strategic asset allocation decisions and tactical asset allocation decisions. Can you expand on the differences between the two and also the pros and cons?
Yeah, sure. Maybe first of all, asset allocation is a prime performance driver for wealth creation. Definitely, over time, a portfolio return is explained 90% of a portfolio return is explained by asset allocation. But you need to combine strategic and tactical asset allocation. Strategic because over the long term, a diversified portfolio can deliver a 6% return over time, a 50% equities, 50% bonds. But such a passive portfolio can lose more than 30% during a big market collapse like in 2008. So that's why you need to implement a tactical asset allocation in order to capture asset class rotation, to bring some diversification and to protect capital when markets are falling.
And naturally, as with everything, there is no one-size-fits-all strategy when it comes to portfolio diversification. What steps should an investor take to ensure that their allocation strategy is built for purpose?
It's a really good question because for the investors, there is just one question. What is the maximum loss I can tolerate? What is the maximum drawdown I can accept? If you are very defensive, you can accept a 5% peak to bottom loss or 10%. It's a very good question because when you are able to understand your risk aversion, you will implement an investment process that will match this risk target.
So once your asset allocation strategy is in place, how important is it to stick to targets, or should your allocation be adjusted regularly?
The key word is discipline. You have to stick to your plan, stick to your process. I remind you that over 20 years, the average investor earns less than 2.1%. It's less than inflation, less than cash. Why is that? Because average investors tend to buy high and sell low. This is what we call the behavior gap. And in order to bridge this behavior gap, you need to implement you need to implement an investment process with very tight discipline. Stick to your investment discipline. It's key over the long term in order to protect your capital and to deliver a steady return.
So Emmanuel, what trends are we seeing at present then? Which asset classes are outperforming and what is underperforming at the moment?
Well, today, definitely the case is supportive for equities because price momentum is good. Micro fundamentals are outstanding. The corporate sector is in a very good shape. From a valuation point of view versus cash, government bonds or credit, valuation is very attractive for the global equity market. And the reflation is a fantastic driver for what we call the great rotation from fixed income to equities. We estimate more than 1 trillion that will move from fixed income to equities over the coming quarters.
Now, Emmanuel, we're going to give you the opportunity to put those ideas into practice with the Dukascopy question, whereby we ask our guests if they had $1 million to invest for 1 year, which asset class would they place it into? Now, these are your options today, so we'll see how they line up. We've got real estate, equity, bonds, gold, cash and oil. Now, I think I know where you're going to head with this, but Emmanuel, $1 million for 1 year. Where would you place it?
Equity.
You're sticking with equity?
Absolutely.
That is great. Emmanuel, thank you very much for your time today. We appreciate your comments. That's all we've got time for right now, but stay tuned. I'll be speaking to Elias Ashkar of the UMass University. Goodbye for now.